As kids, we all enjoyed playing this game, spotting the difference between two similar looking images. No, we are not going to play this game now, but a more interesting one that is related to your money. Suppose you are looking to invest in a fixed deposit and I give you three options. Which one will you choose? In the first option, you receive FD at a 7% interest rate. Second, the FD has annualized yield of 7.19%. And in the third option, FD carries an effective annualized yield of 7.7%. So which one would you pick? If your answer is the third one, as it has the highest rate, then hold your horses because there's a plot twist. What if I tell you that all these FDs actually have the same interest rate? Yes, you heard that right. But how is it possible? Well, these are different terms used by banks to make some FDs seem more attractive to customers, but the actual returns may not be the same. So how is this financial magic trick pulled off by the banks to make the bank FDs look more attractive? Is what we are going to discuss in today's video. Hello and welcome to our channel 5 Minute Finance by ET Money, where we discuss about personal finance and investing. So first is the actual rate of interest. When you start a fixed deposit, you first look at the rate of interest you will receive for the specific term for which you want to deposit your money. For instance, SBI is offering a 7% rate of interest on deposit tenure of 2 years to less than 3 years. So if you invest 1 lakh after 3 years, you will have 1,21,000. But is that the full picture? Well, not quite. Let's understand annualized yield and effective annualized yield first. Most FDs in India follow quarterly interest compounding, meaning that instead of getting that 7% interest at the end of the year, the interest rate is calculated every 3 months. So 7% divided by 4, that is 1.7%, is added to your principal at the end of each quarter. So at the end of first quarter, you have 1 lakh plus 1.75% interest. That comes out to be 1,01,750 rupees. Now the quarterly interest for the next quarter will be calculated on this amount. So basically here what is happening is that you are earning interest on your investment as well as the interest earned in the previous quarter. So after the first year, your balance becomes 1,07,186, which translates to an annualized yield of 7.19%. So annualized yield is the rate at which your money grows every year. The annualized yield takes into account the extra money you earn due to quarterly compounding of interest. Let's now move to the effective annualized yield, which is a little bit technical, so listen carefully. Now this metric takes into account the entire investment period. Let's say you are investing for 3 years. So by the end of 3 years, your 1 lakh has grown to 1,23,144 rupees. So we can say that your money has grown by 23.14% in these 3 years in absolute terms, right? Now divide 23.14% by 3 years. We get an effective annualized yield of 7.7%. This does not mean you're actually getting 7.7% interest every year, but rather it's a simple average across the entire tenure. Here's the most interesting part. The longer you keep your money in, the higher this number gets. So in our example, for a 5-year deposit at the same interest rate, the effective annualized yield comes out to be 8.3%. Okay, now that we have broken down the different terms, you might be wondering, why does this matter? Well, if you are comparing FDs from different banks or financial institutions, you will often see them using different terms to make their offer seem more attractive than their competitors. A bank might advertise a higher annualized yield or effective yield to make you think you'll be getting a higher return on your FD. But here's the catch. If you don't understand what these terms means, you might pick an FD that seems better on its face but actually is not. So the key is to always look at the actual rate of interest on your fixed deposit, not anything else. After comparing the actual rate of interest, then you should calculate how compounding and length of your investment period affect your returns. So, key takeaways. The actual interest rate is the simplest and most transparent measure of how much your investment in a bank FD will earn. The annualized yield shows the impact of compounding within a single year, which is usually a bit higher than the actual rate. The effective annualized yield looks at the full investment period and gives you an average return, which can be a little misleading if you don't understand it properly. Understanding these terms will help you make better, more informed decisions when it comes to fixed deposits. If you found this video useful, please share it with your friends and family and make sure to like it. If you have any questions, do let us know in the comments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.